everybody, and welcome to the Virtual Insurance Town Hall. This webinar is hosted by the California Insurance Commissioner, Ricardo Lara, and Assemblymember Buffy Wicks from District 14. I'm going to go over a couple housekeeping rules. The audio, video, and chat will be monitored and recorded. This event is being streamed live on Facebook. And we respect all participants in this group today, and we want to create a safe space for everybody. So by default, all participants will be muted, and video and chat features are disabled. Video will be on for speakers only. And one other housekeeping note I want to talk about is our department's website, hotline, and online services are currently unavailable, but our IT team is working hard to resolve the issue as quickly as possible. We hope to have this issue resolved in the next 24 to 28 hours. And our offices will be closed on Thursday in observance of Independence Day, but we will resume normal business hours Friday, July 5th. Our agenda today, we'll start off with Assemblymember Buffy Wicks, followed by statements by the Insurance Commissioner, Ricardo Lara, and his Q&A, followed by Sharon Taylor, the Vice President of the Personal Insurance Federation of California, Joe Loucher, the Program Specialist from United Policyholders, and finally, Philip Irwin, the Broker Liaison and Public Relations Representative from the California Fair Plan, and that will also be followed by Q&A for those three gentlemen. Thank you very much. And Assemblymember, thank you for having us, and the floor is yours.
Thank you so much for having me here today, and I want to thank the Insurance Commissioner and all the panelists here. As mentioned, my name is Buffy Wicks. I represent the beautiful East Bay, Oakland, Berkeley, Richmond area, and I'm really happy to be here. I know that this is a really, really pressing issue, frankly, not only for my whole district, but really for the state of California. But I hear it a lot in my district. Obviously, we have the drama from the fire in the hills in the 90s that I think many of us still think of often. I live not far from where that was, so it's definitely top of mind for many of us. I know there was, I think, actually a peak fire today in the hills that I believe is contained now, but we're just sort of one spark away from that kind of trauma. And with that, then the homeowners insurance issues that we are facing because of the climate change issues that we're being confronted with, it's become a crisis on top of a crisis. And so the insurance crisis is ever present because of some of these issues. I know tens of thousands of California homeowners, especially those that live in our areas, have lost insurance or have to pay significant amount of money to keep coverage. Several of the major insurers have stopped offering new policies, and several other major providers will not offer new policies or renew existing policies statewide in certain zip codes. I know that it's a big issue, and in our district, many residents are experiencing non-renewals due to the density and wildfire risk that we're seeing. This is also impacting the housing crisis for many reasons, and these things are very much tethered together. I know that for the policies that are still available, rates are continuing to increase. Zip codes in my district have an average annual home insurance premium ranging from $1,282 in Richmond to $3,763 in the Berkeley Hills. So many of you have reached out to my office with concerns and questions about what the state can do to address this. And so I just deeply appreciate you reaching out. I hear you, we hear you. We want to work towards solutions to help on this issue. We know that it's a wide-ranging problem, and we're hearing for you. So hearing from you. So that outreach is really informs the work that I do here in the legislature. I'm looking forward to hearing from the Department of Insurance and the industry experts who are here today. So I know that our three panelists were already introduced earlier. I do have to jump into I'm jumping around. I'm actually on the floor of the assembly. See, I popped out. We don't have session right now, but I popped out to use the floor real quick, and then I got to go back to committee hearings and what that. But I wanted to take a second to introduce our insurance commissioner, Ricardo Laura, so that he can share about his experience and the work that he's doing on this every single day to try to address this crisis. Ricardo became insurance commissioner at a tough time. We very much appreciate his leadership. He's overseeing the work of the nation's largest state agency, consumer protection agency in the country. Since he took office in January 2019, he's really acted to protect California consumers and small businesses, and really getting billions into auto insurance premium refunds for drivers, and protecting coverage for wildfire survivors and homeowners, and trying to really tackle the root cause of the climate change, intensified natural disasters, and expanding healthcare access and all kinds of other things, while trying to preserve a competitive insurance market, which that is no small task. So I'm thrilled to have him here today. I greatly appreciate his work. And I just appreciate everyone being on the Zoom today for their effort in this. And it's going to take all of us to fix this problem. And I stand ready, willing, and able to help you. And just real gratitude to all of you, to the renters and homeowners that are experiencing this. I see you, we hear you, and we want to be part of the solution. So with that, I'll turn it over to the insurance commissioner.
Thank you, Assemblywoman. I don't miss those days of running back and forth into different committees, but I did want to just thank you for giving us an opportunity to participate in this town hall. I'm looking forward to a good conversation and answering some questions that your constituents have. I want to start by really talking about the diverse range of insurance challenges that we're facing in California. The Assemblywoman alluded to some of these issues that we've been dealing with, all that have really essentially doubled and quadrupled all at the same time, simultaneously, which have really been a challenge for our market. And really, talk about the steps that we're taking to ensure Californians have access to fair, affordable, and reliable insurance coverage. Our department is really dedicated, again, to helping people we serve, understand, and make the most of their benefits. Using the tools at our disposal, our goal is really to safeguard the integrity of the insurance market, composed of consumers, drivers, homeowners, businesses, and making sure that insurance companies remain solvent in our state is also critical. And we're addressing really decades-long neglect in the department, and really taking on powerful special interests to make insurance more available, which in turn will lead to greater affordability. So I think we can all agree that many Californians are facing, and we are facing, an insurance crisis. Prices have increased nationally. We need to get back to a point where insurance companies are competing for your business to drive down that cost. California, I must say, still has lower rates than Texas and Florida. We are right in the middle nationally, given all the risk and fires and floods, earthquakes that we've suffered through the last couple of years. But risk continues to increase to the point where insurance is becoming much more unaffordable for some, and we recognize that. It's unacceptable, it's really unacceptable, which is why we are working on really short-term and long-term solutions to help consumers keep and get the coverage that they need, especially in Assemblymember Wicks' district, because we know it's one of our priority communities that we're looking at. When you look at our market, the top 12 insurance groups cover 85% of the state's homeowners market. Since 2022 alone, 7 of those top 12 insurance groups, have paused or restricted new business. This is despite justified rate increases that we've approved or pending by my department rate experts. So over the past decade, insurance companies have done far worse in California than nationally. During those years, California experienced, as you all know, firsthand, 9 of the 10 largest wildfires in our state's history, and 7 of the 10 most destructive wildfires. As a result, we face a tough question. Can consumers actually get insurance they need? And today the answer, unfortunately, generally is no. We hear that, we see that in all the different articles that we've been collaborating with different newspapers. Because climate change impacts are completely accelerating, we need to take actions to expand insurance availability really over the next 10 years. So Our California Sustainable Insurance Strategy that we unveiled is really a result of meetings with California homeowners, businesses, fire chiefs, agents, realtors, homeowners associations, summer camps, farmers, ranchers, and many other communities across the state, certainly informed by the several community meetings we've had in Assemblymember Wicks's district. We've held meetings at all 58 counties. This is really unprecedented for our department, quite frankly. And our goal is to create a modern, sustainable insurance market that incentivizes safety and risks, and reduces risks, I should say. We don't want a market that retreats from high-risk areas, but instead utilizes long-term strategy to continue providing coverage and consumers, and also allowing the use of technology that can help us determine where are we going to be most at risk in the future, and how do we mitigate that? My strategy really consists of several components that together will make it easier for all Californians to have access to insurance. And we're essentially really looking internal, and then also looking at what do insurance companies need, what tools they need, so that we can better assess our risk. So we are streamlining the rate application process. We are introducing risk management tools such as catastrophic modeling. California is one of the few states that does not allow for the use of catastrophic modeling. It's ridiculous to me that we haven't done this. I mean, we are California. We should be using forward-thinking technology to help us assess the risk and manage that risk. The net cost of reinsurance, which is, again, reinsurance is what insurance companies buy to cover themselves, to make sure that they have enough revenue to cover claims should a catastrophe occur. California, again, is one of those states that does not allow for the net cost of reinsurance to be covered. So all this exacerbates the need for insurance companies to further harden, to further restrict their writing, because they can't have access to these tools. But my conversation and why this deal is historic is, okay, so I allow you, insurance company, to use catastrophic modeling and the net cost of reinsurance. What do consumers get? What do I get for consumers if I allow you to use these tools? Well, they committed to us that insurance companies will write at least 85% of homes and businesses in wildfire distressed areas. And we're going to strengthen our FAIR plan, which is the insurer of last resort. So what does this all mean for the consumer? It means that we have the commitment of insurance companies to write in the Oakland Hills, to make sure that those homes in the Oakland Hills and in the surrounding communities that are in the FAIR plan get taken out of the FAIR plan and given, are prioritized to be given a comprehensive traditional insurance policy. So that is why this deal is so historic, because we're all giving a little bit. We're modernizing our process. We're allowing for the use of these new tools that other states use, by the way. And we have the commitment of insurance and the insurance carriers to write in those communities that currently insurance is unaffordable, non-available, or are being non-renewed. I'm going to go into these three kind of different things quickly, just to let you know where we're at and what the process is. Let's talk about our rate application process. Under California law, insurance companies are free to propose rates at any level. There is no maximum. Insurance companies' rates include estimates for future losses, expenses, and reasonable rate of return. My department is really the consumer's representative in reviewing these rates to give you the best value for the money. We are focused on strengthening our rate regulation branch so that we can meet the current demands of the rate applications before the department. We cannot take years to approve these rates, because by the time the rate gets approved and the risk continues to grow, we're never going to close that protection gap, because that rate is no longer going to reflect the actual cost of that risk. And so we need to do a better job internally to make sure that these rates get approved, that they're not excessive, that they're fair, and that they're not discriminatory, which is all the letter of the law in California. Catastrophic models. Another component of our strategy, as I talked about, is allowing new risk tools that can support greater availability of insurance. For the past 30 years, the department has used historical losses as the method for estimating catastrophic adjustments in the California rate approval process. However, just looking at the past does not give you a full picture, and it doesn't take into account what we are going through right now with wildfire safety, through home hardening, prescribed burns, and healthy forest projects. All that isn't being taken into account in your rate as we speak, because we don't have the tools to be able to lean in and look at, with catastrophic models, at the work that you've done. So we want to make sure that that's taken into account. So we're encouraging neighbors to do the work and have that reflected in their rate. Again, part of our modernization of our department. And the reality is that insurance companies are using CAT models now to increase their rates while, we don't get anything in return. Meaning, so this deal gives something back to the consumer by being able to not only make sure that your rate is appropriate because you've done the hardening, but also give you the discount for your home hardening that you've done. And we are able to verify that now through these catastrophic models. So allowing insurance companies to use CAT modeling in their rate calculations will better anticipate future potential catastrophic losses, so that insurance companies can keep writing in our state because they'll know and be able to see and have a plan for that. So just last week, we held a workshop regarding catastrophic modeling and rate making to discuss the proposed regulations and the commitments insurers must make in order to incorporate the use of catastrophic modeling into the rate making. We've had that conversation with them. And so under, again, the proposed regulation, insurance companies must cover at least 85% of the properties in our distressed areas. To achieve that, they will need to remove policies from the FAIR Plan as well. The new regulatory text takes a hybrid approach that recognizes the complexity of California's insurance marketplace, which is made up by large and small companies, including some serving geographical regions with fewer homes at risk of wildfires. So large companies with major presence in distressed areas will need to write no less than 85% of their properties within the 2 years of the rate filing being adopted, and report their progress back to the department. So we're monitoring, when the companies are coming into communities like yours and removing policies out of the FAIR Plan and into the admitted market. So companies are already meeting the threshold, will be required to maintain those policies in force for 3 years. Smaller companies, new entrant companies, and companies that largely write outside of the wildfire risk areas and cannot meet 85% because they just don't have the resources to do so, or their portfolio is much smaller. We are requiring them for their writing to increase in these communities by 5%. The regulation includes flexibility for insurance companies to draw FAIR Plan policies as well, because at the end of the day, our goal is to take you out of the FAIR Plan, and the FAIR Plan, so the FAIR Plan can remain the insurer of last resort. And we know that, it hasn't. It's been the only resort that you've had. So let's talk about the FAIR Plan. And you'll hear from the FAIR Plan folks who we've been working with closely. And speaking, this FAIR Plan has grown by 20% this year alone, now at more than over maybe 330,000 residential policies. We must reverse this trend of a growing FAIR Plan if we're going to be able to safeguard the state's insurance market as a whole. That's why my sustainability insurance strategy will really focus on shrinking the FAIR Plan, and it will still be a temporary option in the short term for many Californians, but we need to make improvements to the FAIR Plan so that it can serve its legislative intent, which is to create stability in the property insurance market while providing consumers with the best possible customer service. So when I took office, one of the first actions I did was to reform the FAIR Plan. The FAIR Plan had been really neglected for many years under multiple insurance commissioners. Many people did not understand why we pushed for these reforms in 2019, but now it's clear why we did that and how necessary these reforms are for Californians, especially now. So we've increased coverage limits for the first time in 2 decades. We went from 1.5 million to 3 million for residential policies, and from 3.6 million for its business owners policy to 4.5 million for its commercial policy to 20 million for both options. So we are working now to expand that coverage limit even further to help our larger HOAs, our condo associations that we keep hearing from, so that they can have a temporary coverage. So all this that I've talked about, how does the consumer benefit, right? The most important question for me is, how do Californians benefit from our strategy? Well, under our strategy, there's a clear benefit for consumers in the areas where the FAIR Plan has become the only option. So consumers will benefit, I think, really in 5 key ways. One, we're going to make insurance more available by pushing for insurance companies to increase writing in the state, basically no less than 85% of their statewide market share in our wildfire distressed areas. This action plan will expand options in places where the FAIR Plan has become the only option. We will simultaneously decrease the FAIR Plan and make people safer by ensuring the voluntary market takes back the FAIR Plan policies, with first priority given to homes and businesses following our Safer from Wildfire regulation, which is the nation's first insurance regulation for home and business safety. 3, we're going to put a higher value on wildfire safety and rate making, because insurance rates are based in part of historical data that do not recognize the benefit of federal, state, and local safety investments, including fuel reduction projects such as fire breaks, prescribed burns. We will introduce emergency regulations to allow the use of these forward-looking climate catastrophe models that actually do take into account these amazing programs that you should be getting credit for and should reflect in your rates. 4, we're going to continue to modernize the FAIR Plan further to expand its commercial coverage limits to 20 million per building, closing the gaps for larger homeowners association and condominium developments. This is needed now as the market changes are taking into effect, and that gives them time to also do the mitigation in these large homeowners association and condominiums, so they can eventually get off the FAIR Plan. But we need them to get adequate coverage. And lastly, the California Sustainability Insurance Strategy is really a long-term approach to continuing to provide coverage and mitigate risk for consumers. Again, just in closing, our department offers a variety of resources to help consumers understand their insurance options and navigate the insurance landscape. We have a dedicated team of experts available to answer any question you might have, provide guidance for you, and assist people that we serve. We have insurance experts ready by phone or via online chat to help people understand what their options are. We have a top 10 tips for finding residential insurance guide, a homeowner's coverage comparison tool, a premium comparison, and homeowners insurance finder, just to name a few. I'll have staff in the chat box leave our website where you can contact us, and our hotline number. Again, thank you for joining us today. I get it, as Assemblymember Wicks was saying, we see you, we hear you. We're trying to meet this moment and make sure that this crisis doesn't go to waste by really modernizing our department like we've never have before, and allow for these new tools and technology to help us better assess our risk moving forward. And so we are at this moment, and we're going to meet it. I have committed to making all these changes, all these regulatory changes, literally starting from 0 to everything I've discussed, have all this in place by December 2024. And for those of you who work in government or understand how agencies work, that is a revolutionary time frame that we're trying to get this done, all of this in 1 year. And I've committed to the legislature, I've committed to Assemblymember Wicks that we're going to get this done, and we're going to get insurers writing back in your community. Thank you again.
Thank you, Commissioner, for your thoughts. Okay, I have a couple questions. Oh, did he drop off? Oh, there you go. Thank you. Okay, so one of the main questions are, why are insurance companies allowed to cherry pick the zip codes they want to insure? Aren't they supposed to assess the risk and price it that way?
Yeah, that's a great question. You know, it's always important to remind folks that unlike public utilities, insurance companies can limit where they write policies under Prop 103. Current regulations allow for higher rates without requiring increased availability. Even with rate increases, some companies are not writing policies, making the FAIR Plan the only option. Again, this is where our outdated regulations do not address growing climate threats well, we don't have the authority to force insurance companies to write policies in a particular area of the state. We have reached this historic agreement with insurance companies to write coverage for properties in wildfire risk areas that they currently do not insure. So we are confident that our sustainable insurance strategy will improve conditions for the overall market, keeping insurance companies doing business in the state, creating more competition in the market, allowing for consumers to have more choices. And lastly, I would say, under our strategy, insurance companies must detail where they're writing policies in the submitted rate filings with the department. And we're going to use this existing enforcement authority to hold everybody accountable. Insurance companies using catastrophic models will also be required to take into account the steps taken by policyholders to mitigate wildfire risk. So look, we're rewarding consumers for doing the right thing. Insurance companies are going to be allowed to use this technology that they've been longing for and quite frankly needed for so long. And they're going to commit to come back and write in these communities. It's really a win-win for everybody, because at the end of the day, we also have to secure our insurance market in California, and everybody, everybody's going to get a win from this historic agreement.
Thank you for that. So the next question is, when policy renewals happen each year, does an insurance company have an obligation to inform the policyholder of a premium rate and increase?
Again, this is another phenomenal question. Thank you, whoever submitted that. This is the answer is yes. Policyholders must be notified by their insurance company of any premium changes. If you receive a notice from your insurance company that your rate is increasing, you have options. If your insurance company raises your rates, these are some things that we usually tell consumers. Consider shopping around or comparing prices and coverage options with other insurance companies. Think about making adjustments to your policy based on your current situation, and ask yourself questions like, does raising your deductible make sense for you? Consider reducing contents or other structure coverage. Work with your insurer to provide them with the documentation of home improvements that you've made that reduce your wildfire risk. This is why the use of CAT models becomes so critical, because in the future now, you're going to be able, and the insurance companies are going to be able to see that real time and make sure that they adjust your rate, or perhaps write you a new policy because they've seen that you've done the work. And so building your home insurance, bundling your home insurance with your auto or an umbrella policy can also get you a break on your premiums. So these are all kind of strategies that I like to give out there. But again, your individual policy is so unique to you. I would encourage you to call our department if you have any questions. If you receive a non-renewal notice, if you receive a notice of a rate increase and you don't think it's justified, give us a call. We'll help walk you through it. And oftentimes we'll see or catch some things where the insurance company actually rescinds a non-renewal. Doesn't happen often, but at least we can take a look at that with our insurance experts.
Okay, and finally, since this is a insurance town hall and not just a wildfire town hall, how is it not price gouging for my auto insurance to go up 50% in 1 year?
Yeah, I completely understand. And the frustration when you're receiving your policy renewal information and you see that you are facing a 20, 30, 50% increase, it's hard to understand how premiums can change that much in one policy period. But under Prop 103, auto insurance premiums are primarily based on driver safety record, annual mileage driven, and years of driving experience. In addition to mandatory factors, insurers must also consider some optional factors in calculating auto rates, which is outlined in insurance code. For example, I don't mean to get all wonky, but I really think it's important for people to understand the department's rate regulation experts take the lead in thoroughly analyzing the rate change request to ensure that what is being requested by the insurance companies is compliant with California laws and are justified. While rate changes have been approved under Prop 103, if a proposed rate is excessive, the department requires insurance companies to actually reduce the proposed rates. So it's a delicate balance of ensuring that insurance companies remain solvent so that they can pay out their future claims and continue to offer coverage in the state while not charging excessive or unjustified rates. Californians continue to pay less on the average for auto insurance than other states. I'm using, again, every tool to make sure that we protect consumers. Last December, for example, we set out a bulletin to insurance companies. Companies has really helped the market for private passenger auto by reminding them that requirement that they have to write all good drivers. But what we're really doing is, look, everything is much more expensive. Inflation is still having impacts on the cost of auto parts, labor cost, repair. We've seen that since after the pandemic, the rate of mortality and traffic accidents have skyrocketed in California, which is also costing much more, which is being reflected in the rates. We are making sure that those rates are fair, they're adequate. And so again, if you have a rate increase that's that high, call us, talk to us. We can get you in contact with other companies that might not be large or might not have such a large footprint, so that they're willing to maybe give you a lesser rate for your coverage. Again, each policy is so individualized to the consumer. This is why we encourage you just to call us. And I don't like to give like specific details on different policies because everybody has a different policy. But again, we've all noticed the price of everything has gone up. The risk has gone up. Accidents have gone up. The cost of repair for vehicles have gone up. And labor shortages of actually doing the repair, all that's contributing to the insurance costs. But I know we have some of the insurance company folks and trade groups. Maybe they can help me and amplify some of the things that we're talking about today.
Thank you for your time, Commissioner.
Thank you.
Just quickly, next up, before I introduce the next speaker, I wanted to just give you a couple more housekeeping notices. We did receive over 984 registrants for this webinar, so we are inundated with questions. We have over 250 questions. That is why the chat box is not live. The organizations that are participating today have agreed to take their portions of the questions that are addressed to them, and we will work with them as best as we can, and we will disseminate them to the Assembly member's office. Thank you so much about that. Also, I think I neglected to state earlier that we did have a Spanish interpreter scheduled for today. She unfortunately called and she's ill, and we cannot find a replacement within a couple hours notice. So this webinar is being transcribed, and then it will be sent to the interpreter for a Spanish translation, and that will be made available to you as well. Okay, thank you very much. So next up is Sharon Taylor.
Good afternoon. Thanks, Mayor. Oh, go ahead. Sorry.
Let me give you a quick introduction.
Sure.
Sharon serves as the Vice President for the Personal Insurance Federation of California. He represents PIFC's member companies before the California State Legislature and the California State government agencies and departments on the personal lines property casualty insurance issues, including auto, home, flood, and earthquake insurance sold to individuals. Prior to joining PIFC, Mr. Taylor was a key senior staff person for leaders in the Cal State Senate and Assembly for nearly 20 years. So take it away.
Thank you. Thank you very much. And I did want to also thank the Insurance Commissioner, Commissioner Lara, for his leadership. It's been a tough road, as he said, getting to this point, and it's going to take a lot of good leadership to fix it. Those are a lot of tough but fair questions. And then also want to thank Assemblymember Wicks for her engagement on this and the opportunity to be here at this town hall. I do understand there's a lot of frustration, fear, disappointment, and a lot of, I think, misinformation out there as well. So hopefully, I was asked to give a 15-minute presentation here. Obviously, it's a complex issue and we could talk for hours about it, but try to put together a little PowerPoint to really give a little more depth and understanding to some of the things the commissioner was talking about with regards to the underlying regulatory problems, the inflation, the change in the nature of the catastrophic peril that we're all facing, and hopefully I don't know if you'll come away satisfied, but hopefully you'll come away with a better understanding of how we got here and hopefully how we're going to solve this problem moving forward. In any case, Mary Beth, I know I have the PowerPoint here. Are you going to give me the share screen so I can bring it up, or?
Rob, are you going to enable that, please? Delaney, can you enable Saren to share his screen, please?
You should be able to share screen now.
Okay, I didn't see a,
Bottom of the you see a green share button.
oh, there it is. Gotcha. Okay. Let's do that. Fantastic. Thank you very much. Okay, so virtual town hall today, Saren Taylor, Vice President of the Personal Insurance Federation. By the way, in the interest of time, I have a lengthy presentation. I'll spend a little more time on some of the things that I think are critical and rush through some others and hopefully be able to address questions.
Sarah, can I
yeah.
just interrupt you if you want to put that into the viewing mode? Because I can see your whole back portion of it.
You can see, I'm sorry, say what?
Hit the little icon on the bottom that looks like a movie screen right there by your cursor.
You talking about this?
Yes.
Ah, all
There you
right.
go.
I didn't know that, but now I don't know how to move it. How do I move it forward?
You just
Oh, here it
press-
is. I got it. I got it. Okay, I see. I
Huh?
think I've never done this before or something. In any case, let's start right here. So as the commissioner talked about, here are the PIF represents actually 11 companies, and we have 2 associate members that are 76% of the market. As the commissioner talked about, there's about 12 companies representing over 80%. So we have a lot of the large market share companies. There are over 100 admitted insurers in California, but obviously a lot of the market share is concentrated in just a few companies. We'll talk about some of the key issues here, the catastrophic losses, the hyperinflation that went through COVID. And that was also what the commissioner talked a little bit about in the context of auto rates as well. It had significant impacts there. We'll talk about the outdated regulations and the Fair Plan program. Again, as the commissioner noted, we had 8 of the top 10 wildfire losses in the history of the planet have occurred in California. And 9 of those 10 have occurred since 2017, 7 of those in California. And I know because of the Assemblymember's district, it's interesting to note that back in 1991, the tunnel fire was through the Berkeley Hills. And that was really the first major catastrophic wildfire in California. And you really didn't see anything like that for another 26 years. And so on this next chart, to me, this is actually probably the most, if I can only do one chart, this is the chart I would share with everyone to understand sort of how we got here. And you can see over here, this is the tunnel fire that we just talked about in the Berkeley Hills in 1991. And that was the only major loss fire in the history of California. And you can see sort of this is insurer underwriting gains and losses over 30 years. And generally, they made a few $100 million, lost a few $100 million. And the system was rather predictable. You didn't have huge catastrophic losses. We went through decades of really low, moderate inflation. And the weaknesses in the current system really didn't impact a lot. It was just sort of stable and going along. And then as you start to get into the early 2000s, around 2005, 2006, there was really a series of good years where insurers continued to build their underwriting gains, a couple $100 million each year, just growing and growing to the point where by 2016, they're about $10 billion to the positive, right? And that looks great. But what you don't see is all the risk that's coming in front of you here. And of course, in 2017, right here, this was primarily the historic Tubbs Fire in Sonoma, as well as the Thomas Fire down in Southern California. And that one year, those two fires primarily wiped out the prior 26 years of underwriting gains, gone in 1 year. And at that point, insurers had a question because they hadn't seen such a significant losses since 1991. And the question was, is this a new normal or is this another outlier event? And unfortunately, that question got answered in 2018 with the Camp Fire, primarily the Camp Fire in 2018, which again wiped out, would really doubled down on the 2017 losses to the point where insurers were, over $10 billion now negative over this 26 years. And then you can see since then, it's slowly sort of built back. But we're still, as of the date of this slide, which is 2021, everything lags, by the way, and this data usually lags 2 or 3 years, but we're still about $3 billion in the hole even today. So that goes towards still the struggles. So let's move forward over here. You can see again, just the inflation over 2 years, just from January 2020 through December 2022. A lot of people probably recall the price of eggs spiking to $8 a dozen. The price of wood went up 30%. Gas was at $7, $8 a gallon. And of course, residential construction goods and labor went up almost 35% just over those 2 years. So just to give you a sense of what that means, even forgetting about the wildfire losses, just on inflation alone, if you did nothing, an insurer, their risk exposure went up 35% if you didn't even have a single fire, right? So when you see these rate increases and you're like, what is going on? And I'm, things like that, I'm getting gouged. You're not getting gouged. Everything everything's more expensive. When you go to the grocery store today, and I know with my family, I go in, I'm now spending $400 on a grocery shopping that just 3 years ago was $225, right? This is now our reality, and this is the cost. It's 35% more expensive to rebuild a home. Have your handyman come over, because my handyman went up from $35 an hour to $50 an hour, and that's in Sacramento. So this is real. Climate change is real. Inflation is real, and it affects insurance the same way it affects your groceries, and it affects restaurants, and I'm sure it's affecting all of your businesses and your lives as well. Insurers are not immune to these factors. So again, to the commissioner's point, I got really tired of certain consumer group, not Mr. Lauscher's group, but going around the state trying to say that insurers are doing great. Everything's fine. This is some kind of game. This is not he said, she said. This is the Department of Insurance slide right off of their own website. The commissioner talked about it. Over the past 10 years, homeowners insurance companies have done far worse in California than nationally. And if you just look here at direct underwriting profits, like we're talking about, countrywide, 3.6%, reasonable rate of return. California, minus 13.1%. Okay, that's the real world as to what's happening for insurers in California. So looking at that another way, here's data from the National Association of Insurance Commissioners. If you look back here to 2010, you can see California was probably the 17th highest in terms of its premium rates, about $939. Now look to 2021, and we're now actually the 20th highest. So we've gotten actually lower in terms of relative to other states where our rates are. Probably hard to believe given the rate increases, but you can see over here, California's gone up 49.4% since 2010. Nationally, it's been 55.2%. And certainly in other climate affected states, you could see also significant increases. But California, even today, is $1,400. That's actually under the US average. I don't know that there's another thing you could point to in California where they're actually lower than the US average. Think about prices of homes, prices of electricity, prices of gas. We're higher in everything except insurance. Other climate adjusted states are close to double what California is. And by the way, the cost of rebuilding a home in Florida is, I want to say, less than half of what it costs to rebuild a home in California. So think about that as you think about, doesn't feel like rates are low here, but relative to other states, believe it or not, California actually is a very reasonable to low cost insurance state. Moving on from here, we'll talk about some of the really the outdated regulations that the commissioner was talking about. So here he was talking about the filing times, and I'm really sympathetic to the department on this, you know, as difficult as it is, because they had a lot of COVID retirements. Give a lot of credit to the commissioner. They're doing a lot to recruit people to work there and process these filings. It's an expertise that's hard to find. They have a review pending on their whole rate regulation branch to figure out how to streamline things and to do increase their staffing there. And we are very supportive of that. And the insurers pay for that. The insurers pay for all the Department of Insurance staffing to get this job done. And we're continuing to be willing to fund whatever they need to get that job done. But you can see here, the average time to approval has grown from 274 days just in 2020 to up over 350 days. That's almost a year since you put your filing in. And as the commissioner talked about, by the time your filing's through, if you're in a stage of inflation going up 15, 20%, you're already 20% more rate adequate than you were when you started. So we need some confidence and consistency in the rate process. So what are the solutions here? The solutions that the commissioner talked about are getting out of this system of looking backwards at historical losses to project what's happening going forward in a world of climate change, right? As the commissioner said, California is the only state that prohibits the use of catastrophe models. Catastrophe models allow you to, you know, when we were at a time when we were 5 years of drought and 200 million dead and dying trees going into 2017. And all insurers could do was look backwards, and there hadn't been a major loss since 1991. Everyone knew that a big loss was coming, but you couldn't do anything about it. And that's where we are today. But again, credit to the commissioner and a sustainable insurance strategy. They have regulatory proposals to now allow the use of catastrophe models in California. I'll move forward on that and talk about reinsurance. Here's where the commissioner was talking about the use of reinsurance. In every other state, the net cost of reinsurance is just the cost of doing business. It gets built into your rates. It's a way that it's really insurance for insurers, and it's a way that they socialize California risk across the globe and also bring more capital into California so that they can write more policies. You need reinsurance in order to write more policies. And again, this is something that the commissioner in the sustainable insurance strategy is looking at allowing in California. And just like flour in a cake for a baker or cement for a builder, that's just the cost of doing business. And we need it to be recognized if we want to increase availability of insurance in California. All right, so let's talk about the FAIR plan. I know a lot of people refer to it as the unfair plan. It is an important safety valve, and other states are, believe it or not, are looking to add a FAIR plan because they don't even have one. I need to update this chart. This is as of 2022, but you could see FAIR plan normally had been around 175,000 policies, got down to a low of 125,000 policies in 2017, and then exponential growth. If you were to look at it today, it's up about 350,000 policies, and we're heading towards 400,000 probably for the end of the year. And that is completely unsustainable. We need to stop the growth of the FAIR plan and return people to the admitted market. Here's some of the concern for insurers. Now, while this exposure growth is happening in the FAIR plan, they don't have capital to pay those claims. The FAIR plan has about $200 million in the bank to pay claims. And if they have an assessment, that assessment is going to be put on the admitted market insurers to pay for premiums they did not collect, for risk they did not want. And you could see here, each of these blue triangles represents a 7-mile little semicircle. So in Lake Arrowhead, for example, in that little area, there's almost $8 billion of exposure, right? Crestline, almost $7 billion of exposure in that area. One fire could be $7 billion. Up north, look at Grass Valley, look at Nevada City, look at Truckee. Berkeley Hills would probably be a mini microcosm of that. But this is the kind of exposure they're facing, and all of that then falls back on insurers to cover those losses. The FAIR Plan had asked for a large rate increase several years ago, only got 15% of that approved, and they are still woefully, as expensive as they are, they're underpriced even today. Now, so the reward for an insurer who grows their market share is they get a bigger cut of the exposure to the FAIR Plan losses. So we need to deal with this massive disincentive of the FAIR Plan exposure and find a way to cap that liability and move people out of the FAIR Plan and back to the admitted market. Just to emphasize, this is not a game. AM Best is a 100-year-old rating entity. They downgraded the U.S. homeowners market from negative to stable. And I will tell you, State Farm, who is by far the largest insurer in California with 20% of the market, they were just recently downgraded by AM Best from I want to say from A to B. A B rating from AM Best. If State Farm were to go any lower than that, there would be the potential that their coverage would not qualify as adequate for a Fannie Mae or Freddie Mac loan. That would be potentially 1 million plus or more homeowners whose State Farm insurance now is not adequate for the mortgage. So having State Farm, as frustrating as people may be, I know particularly in Orinda, with their freezing of new policies in California and some recent non-renewals, if they don't take those steps to stabilize their financial losses, then everyone's insurance could be in jeopardy. So as frustrating as it is, it was absolutely a financial necessity to take the steps they had to take. So, all right, enough of the doom and gloom. Let's talk about how we're going to get better, right? What's going to happen? So mitigation, this is incredibly important. The Insurance Institute for Business and Home Safety is the primary research organization. Remember, this is still new science. Prior to 2017, wildfire risk wasn't even considered a major peril. There was earthquake, there was flood, there was hurricane. Wildfire wasn't even something that anyone thought was going to be a problem. So in just a few short years, we now have a wildfire prepared home standard that I'll show you. The Department of Insurance has put out a safer from wildfire regulation that requires insurers to recognize these mitigations. They look at, is your home, if you're 2008 or newer, you're probably Chapter 7A compliant. Have you done the defensible space? Have you done some of the other parcel level actions consistent with the research? What is the state of the community? Because the individual home is important, but the overall community is what matters the most. And hopefully we're going to see a new standards for what community mitigation looks like. That there isn't agreement in the fire science community about what that is. A FireWise community designation is nice. It just means that there's a culture of awareness of fire. It's not an actual standard of fire science. So let me go here. Here's what the IBHS Wildfire Prepared Home looks like. It looks at sort of what is your building features? Do you have ember resistant vents? Do you have 6-inch of vertical clearance from the ground? It looks at this is what we call the 0 to 5 foot ember resistant zone. That is incredibly important. Obviously, you want to have a fire rated roof. You want to maintain the space going out from your house, 30 to 100 feet. And then there's even a higher standard called Wildfire Prepared Home Plus. And then that gets into having non-combustible siding. It's having wildfire resistant decks, making sure you have multi-pane windows, things of that nature. You may have to move outbuildings 30 feet away from your house, depending on your property. So these are now what the science is telling us that folks need to do on their property. But mitigation, understand, mitigation is not elimination. This just means that you are marginally less risk than your neighbor. And I just want to say, you know, when you get a wildfire that's wind driven and the winds are blowing 50, 60 miles an hour, like we've seen in Paradise and we saw in the Tubbs fire, there's very little that's going to withstand that. When I toured some of those places, you know, not to scare folks, but the fire captain pointed out, there was a home that was a cinder block building with a metal roof, and it just got so hot it exploded. There were cars whose metal rims had melted into the streets. So mitigation's important, but it's not elimination of risk. And insurers will look at that, recognize it, but you still got all these other factors that insurers have to consider. Again, capital to write policies. Are my rates fair and adequate? Do we have a stable regulatory system that I can do business in? Those are the factors that are driving insurer decisions right now. Less focus on, do you have, you know, attic events in your house? So let's go now, though.
I'm sorry, Sarah, we're gonna have to move on because we're running out of.
This is the last slide right here. So California Sustainable Insurance Strategy, just to understand the benefits, insurance availability in at-risk areas, as the commissioner talked about. Insurance companies are going to be required to write no less than 85% of their market share in distressed areas. That map and list is out by the department. You can look at your zip code and see if you're in there. Depopulating the FAIR Plan, returning FAIR Plan policyholders back to the admitted market. In return, the insurers get to use cap models and reinsurance in their rates. And the FAIR Plan obviously gets, as the commissioner talked about, expanding their commercial coverage for HOAs and others. And this is, you know, this is, as the commissioner talked about, moving in 1 year. It seems slow, but it's lightning fast for government. It took us over a decade to get into this problem. And now we finally have agreement on the problem. We have agreement on the solution. And we are hopeful that we're going to be able to move forward and restore a healthy and reliable market in California. Sorry to take so long, but thank you for your time. Look forward to your questions.
Thank you, Sarah. Our next speaker is Joe Loucher. Joel is a former insurance underwriter who joined the California Department of Insurance as a market conduct examiner, and he subsequently served as the division chief of consumer services, the deputy commissioner of rate regulation, and as our chief deputy commissioner. He now works for the nonprofit United Policyholders as a consumer advocate. Great to see you again, Joel. You're on.
Thanks for having me, Mary Beth. And thank you to Assemblymember Wicks and Commissioner Laura. I am going to go as quickly as I can here and still deliver the information that I think is helpful to people. Obviously, we are at a place where insurance has become forefront in a lot of people's minds, just in part because it's expensive, but also due to the fear of non-renewal notices coming in the mail. So next slide, please. So first, just to let people know, I work for United Policyholders. It's a nonprofit. It came into existence after the tunnel fire in Oakland. Its main focus has been helping people with catastrophic loss events, with very challenging claims issues that arise. But now we are also involved in helping people kind of understand the insurance coverages they need, and in this market, how to search and find for the coverage that's available. Next slide, please. So as we are hearing, you know, insurance is now something that would draw 500 people to join in on a Zoom in the middle of an afternoon. And I'm sorry we're in that place at all. Used to be something that was largely ignored, but now people are spending a lot of time and money to find or keep their insurance. Next slide, please. So despite these issues, we still want to remind people from United Policyholders' perspective that you still want to make sure that you have adequate insurance for your home. For example, if you have a 2,000 square foot home and you have a $600,000 limit on your homeowner's policy for the dwelling, that equates to about $300 per square foot. That is likely to be nowhere near what it costs to rebuild in almost any region in California. Try to get an idea at least of the construction costs in your region, and at least get your limits somewhere into the range of reasonable. I know that's hard to think about in times when premiums seem so high and are going up, but there's still a reason that we buy insurance, that is to take care of our costs in the unusual event that we have a total loss. Nobody thinks they're going to, but obviously it has happened to many Californians and people worldwide, and we are fortunate to have the option of having homeowners insurance. So check your limits, make sure they're, again, within the range of reasonable. Next slide, please. And also, while we're at it, we also suggest that you inventory your personal property. Even after a total loss, an insurer can ask for a lot of information before they're going to pay out your contents claim. For every item that you want to have reimbursed for its loss, they can ask you to list the item, the date you bought it, how much you paid for it, and the condition it was in at time of loss. And hard to imagine doing that for every item in your home, but that's kind of how insurance works. And then they pay you the actual cash value. And when you actually replace the item, they pay you the remaining replacement cost. So how do you remember all those items? Well, you can write down all that information about every single one of them, everything that you own. But another option, at least that can be very helpful, is at least walk through your home with your phone, using your video, to video everything in your home, including in your drawers and your closets and your cabinets, so that you can show the insurer, yes, I did own these things. And often that can lead to a easier reconciliation of a personal property loss claim. So 10 minutes, you can walk through, video everything in your home, store it in the cloud. It'll be available to you in, again, the remote chance that you ever have a loss. Next slide, please. Now I want to talk about, the situation people are in today and what they can do about it. Again, very challenging, but if you get that non-renewal notice or sometimes an advance notice from an insurer, you need to get to work looking for coverage immediately. It is a tough market, tough to find an insurer that is writing in almost any region of the state. So it really means you're going to have to call a lot of insurers that you may have never heard of, but are admitted insurers writing coverage in California. So don't delay. We say start shopping right away. Keep track of every insurer you have contacted or from your agent, which insurers they marketed your policy with. You really want to make sure that you have thoroughly shopped the market before potentially ever having to accept a fair plan coverage. You don't want to settle for the fair plan if you can find coverage anywhere else with an admitted carrier. Next slide, please. So that was you can see that webpage on uphealth.org. The commissioner already mentioned as well, there's a page at the Department of Insurance website that's also very helpful. That includes many shopping tools, including the top 10 tips of what to do, if you're searching for coverage, an insurance finder tool, a chart of insurers offering discounts. There's the 800 number on that top 10 tips, includes the 800 number of every admitted insurer that's doing business in California. And again, I want to mention admitted insurer are those who are doing business in this state and are backed by the California Insurance Guarantee Association. So that's an additional financial advantage that you want your insured to have, that additional security of being able to pay its claims. If you do end up with what's called a non-admitted insurer or surplus lines insurer, you want to really check out what their financial rating is. Typically through BESTs, what you're looking for is an A rating, or at very least a B+ rating, before you settle for a surplus lines or non-admitted insurer. Next slide, please. So if you do end up in the FAIR plan, remember, it's basically a fire policy, very basic coverage. Even that fire policy's provisions are much less than the coverage for fire that's built into a homeowner's policy. So you're going to have to add on a lot of kind of the optional coverages that the FAIR plan does offer. But even with those, you're still going to need an additional policy, typically called a difference in conditions policy, or a wraparound, or a DIC. That policy, DIC, includes coverage for things such as water damage, which is typically like the second most likely cause of loss that we have in homeowners policies is water damage, right? A plumbing line bursts, or a washer breaks, that's upstairs, and the water spills over and damages floor and roof beams. So you really need a difference in conditions policy. I also mentioned as liability coverage. Liability claims are relatively rare for residential coverage, but they can be very costly. There's a trip and fall on your property and someone's injured, you'll want to have liability coverage. So these two policies combined represent comprehensive coverage, somewhat equating to what a current homeowner's policy would provide on its own. Again, check out our website, uphelp.org, the California FAIR Plan information there. Next slide, please. Again, here's some add-on options. For example, adding on replacement costs, something that can be that's built right into a homeowner's policy. You want increased fair rental value and code upgrade coverage that come with a FAIR Plan policy, but at minimal limits. And you want to add additional limits both on debris removal and other structures, if you have other structures on your property. Next slide, please. So one thing to understand about how insurance rates play out, I'll let you take a look at this map and see if you can figure out where this screenshot is taken from. It's in the East Bay. You can see a Safeway right there on kind of the main road passing through. There's a couple red circles on this map. They're representing a look at the homes that the insurer is evaluating with a wildfire risk model. And these aren't the loss projection models we've been talking about, but the ones that score your home. And that can make a big difference both on whether your home is eligible for coverage with an insurer and how much you'll pay. So this is what an insurer kind of gets. For last 20 years, they've been using these satellite images to determine the slope, fuel, and access of the location of that home, again, to play into that decision making. And just the slight difference between these two homes in the center of these circles can mean the difference between a much higher rate or being ineligible for coverage. The red circle on the right focuses on a home that's a little further up the slope and a little closer to the open space at the top of the hill that you can kind of see in that upper right corner. So these, again, there's not much you can do to change your score from one of these images if this is still the tool your insurer is using. Next slide, please. But there are newer, more updated tools that get a much more, we'll say, granular look at your home using aerial imagery. This is kind of this kind of look in concept of what an insurer can see using aerial imagery. So it can work for you or it can work against you. This home might be on, lower slope, but the additional detail we see indicates that there are obvious tree limbs reaching out right over the roof of the home. There's just a lot more detail an insurer can get from some of this imagery in terms of how much defensible space you have, what type of roof you have, and even other additional information that might be loaded into the algorithm so that it knows the date your home was built. Then the insurer would get from the same score some of the building code information about your home. For example, whether it has ember-resistant vents. So anything, if this is your home and you make any changes to it to make it more resistant to ember blow or wildfire, you're going to want to report that to your insurer. If you remove those tree limbs, you're going to want your insurer to know. So again, this is kind of the way the market's working today. Again, details you, of course, might not have even known that your insurer had this information. Next slide, please. So when you hear about a rate increase approved by the department, there was a lot of press about State Farm's 20% rate increase that was approved. Know that that is a 20% on average. And I've taken that State Farm increase and showing you some of the details of how that played out by zip code, for example. That's one of the ways it plays out differently. Here I'm in the purple. You see one zip code, 94704, is for the Berkeley Hills. Another one in the purple shading is 94801, Richmond, here in Assemblymember Wicks District. You can see on average that second number, the increase in 94704 was only 8.8%. And in 94801, it was 10.1%. So still pretty big increases, but much less than the 20% average. And just to give you an idea, or maybe make you feel a little better about how your zip codes played out, the last presentation I did was for Topanga Canyon. Here you can see their average percent of increase in their vicinity by State Farm was 46.5% on average. And of course, that average means some homeowners paid more than a 46% increase and some paid less. When I gave Topanga their presentation, I had to add in Big Sur and its zip code as a comparison because it was actually higher than Topanga. But these are how they play out. It varies very broadly based on your exposure to wildfire, your loss history, and other rate components that the insurer considers, such as type of roof, age of home, and for example. Next slide, please. And again, tips to save money, do as much mitigation as you can. That's been brought up. Raise your deductible. I will say that I set my deductible 20 years ago when $500 seemed like a lot of money to have at stake if I had a loss. Obviously, you want a much higher deductible than that today. So raise it to whatever level you can comfortably afford to absorb yourself, and you'll save premium every year on your insurance, no matter what the rate is. You don't really want to be filing small claims anyway that you can reasonably take care of repairing yourself. Next slide, please. We've already mentioned, Saren showed you some of the mandatory discounts, mandatory that insurers provide a discount to each one of these things. These are from that Safer from Wildfires set of mitigations. Please do all of these you can, because for each one that you do, you get a discount, other than with the fair plan where you have to do a whole set of the building hardening ones to get the building one, or the property level ones to get the property level discount. But for every other insurer, each one you do is a separate discount. So do one, you get a discount, and that'll motivate you to do the next. Next slide, please. Again, you can get a lot of information from our website, uphelp.org. We have a dedication to what to focus on mitigating in your home. It's our wildfire risk reduction and asset protection initiative. We have monthly meetings. We're really here to help. It's always free to the consumer. Next slide, please. And the state offers a lot of resources as well. For example, the Listos guides and information. Try listoscalifornia.org for additional information. Next slide, please. And again, thank you for listening. Hope you take our home survey at uphelp.org, California Home Survey. And thank you for listening. And of course, I will welcome any questions at the end of all presentations. Thank you.
Thank you, Joe. Next up is Philip Irwin. Philip is a broker liaison and public relations representative with the California Fair Plan. Although he's been with the Fair Plan since 2019, his experience in the insurance industry spans over 25 years. He resides in El Dorado County, which has more than its fair share of wildland-urban interface. And ironically, he himself is insured by the Fair Plan. So welcome to have you, Philip.
Thank you for having me. It's really great to see this collaborative effort, and it's really great information for everyone involved. I'm going to go ahead, in consideration of time, just jump right in. We'll go ahead to the next slide, if that's okay. I should say the first slide. So some of these details have already been picked up on, but I'm going to go ahead and cover kind of from the beginning. So again, the whole purpose of the Fair Plan is to assure stability in the property insurance market for property located in the state of California. It's to assure the availability of basic property insurance as defined by this chapter, and to encourage maximum use in obtaining basic property insurance of the normal insurance market provided by brokers, by admitted insurers and licensed surplus lines brokers. So we talked a little bit, other speakers have mentioned insurers. Again, in the state of California, there's 118 insurers. There's 132 surplus lines or non-admitted insurers, and then there's one Fair Plan, and all to provide the equitable distribution among admitted insurers of the responsibility for insuring qualified properties. So we can go on to the next slide. So just to clarify, the California Fair Plan is referred to and intended to be the insurer of last resort. It is not a state agency. It's not a taxpayer-funded or state-funded organization. It's not for profit, not subject to Proposition 103, accepts properties regardless of wildfire exposure, and funded primarily through the policies it sells to customers. And for the brokers that are out there, and just for perspective on this, some broker information is their goal is to, and their obligation is, provide a diligent search for insurance to the voluntary market. The Fair Plan does not determine the adequacy of requested limits and coverages. The Fair Plan does not verify insurable interest, and the brokers are not agents or representatives of the Fair Plan. Brokers are not authorized to transact insurance or receive information from others on behalf of the California Fair Plan. We can go to the next slide. So increasing the increased demand, or addressing the increased demand that we've been hearing so much about and experiencing ourselves, ensuring access to basic property coverage, meeting increasing consumer needs, supporting a fragile insurance market, and in collaborating with the CDI, legislature, and other stakeholders to stabilize the market and ultimately depopulate the Fair Plan, which is our goal. There's been a lot of talk throughout the presentation about the growth of the Fair Plan. Here's just some more details, and just looking at the considerable growth, and it goes right back to those timelines that everyone has really talked about. And to me, it's really the campfire, that period, Dixie Fire campfire was really where the catalyst was, the timing was, the time frame was where we saw a considerable growth really take down that path for the California Fair Plan. So one thing to just keep in mind too, we're looking at nearly 1,500 applications a day right now, based on the surge and influx we're seeing. We went, and this is really just probably the number that shocks me the most, is registered agents or brokers with the Fair Plan has increased from 9,000 to 54,000. So obviously, all signs, we're just seeing tremendous growth and surge of activity and utilization of the Fair Plan. So Fair Plan has responded by increasing underwriting, customer service, and underwriting and customer service staff, as well as extending service hours. Going to the next slide. This slide was shared again previously, but again, it just really does highlight the extreme concentration that's in some of the zip codes that are in the wildland urban interface, and it just shows again how much exposure is out there. The 7 mile quarter circle again is really just to reflect, I believe it's the footprint of the same size of the campfire, just to kind of give everyone perspective. So if we were to have an event of that magnitude in these areas, this is the level of concentration of the exposure we have in these particular areas. So we can go on to the next slide. So Fair Plan rates and reinsurance. So the Fair Plan rates by statute must be actuarially sound. This includes expected cost of claims and losses, as well as Fair Plan's operating expenses. The Fair Plan proposes rates based on risk exposure as determined by certified actuary, administrative expenses, and net cost of reinsurance, followed by the California Insurance Code 10095. It also authorizes the California Fair Plan to purchase reinsurance. So go on to the next slide, thanks. In meeting evolving customer needs with our growth, the Fair Plan has launched new application technology system in Duck Creek, hosting and participating educational webinars, town hall meetings, and events for brokers, agents, consumers, and other stakeholders. And again, increased staff and enhancing training and resources. We implemented Zesty AI wildfire risk analytics product as approved by the CDI for when setting rates. We've launched additional policyholder payment options and implemented online credit card payments. We can go on to the next slide. And we're also collaborating with the Department of Insurance and its sustainable insurance strategy. Depopulation of the Fair Plans includes Clearinghouse AB 3012 and SB 505, adequate rates and reinsurance, catastrophic modeling, and Fair Plan sustainability. Thank you. I'm looking forward to answering additional questions.
Okay, since you're up, we'll ask you something right now. Since Sarah brought this up, is the Fair Plan sustainable? How can we rely on it? Considering working with congressional delegations on climate appropriate fixed for the national problem. Well, that's another whole story. But is the Fair Plan sustainable as it stands now?
Well, the Fair Plan needs actuarially sound rates and reinsurance and cap modeling, and overall the market needs to be fixed and restored. So that's really ultimately what is going to be necessary in order to make the Fair Plan sustainable. It's not designed for the growth that we've seen at this point.
Mm-hmm. Okay, then my next question will be for Joel. Joel, okay, somebody's curious whether insurers may reduce the coverage in large areas regardless of the specific risk. They're thinking about the case of the fire risk in the East Bay Hills versus the flats.
So can they reduce the number of policies they write, for example?
Mm-hmm.
Yeah, so the simple answer is yes. Generally speaking, an insurer has to adopt underwriting guidelines and write any applicant that is complies or is eligible based on that set of guidelines. But there is an exception to that, is that the insurer can also account for its financial situation. You know, it has to consider its reserves and its reinsurance limits available to it. And so an insurer can choose to stop writing in any given region, even without changing their underwriting guidelines. Or, you know, they can scale back in area. They could change their underwriting guidelines moving forward at a given point. But I think for most of us, what we're seeing is that either the insurer has hit its financial limitations, or potentially its reinsurance contracts have changed, thus requiring that for the insurer to protect its solvency, it needs to reduce the number of policies it's writing in a given region.
Okay, let me ask you one more. So why are insurance companies allowed to burden homeowners by pressuring them to all but eliminate all their vegetation around their homes when fire specialists, insurance, and homeowners know the danger is in the wildlands? The expense is too much for homeowners, and cutting vegetation next to the home is not even the reason why insurers have left the playing field.
Yeah, I think a lot of folks in suburbia kind of feel that, you know, that, you know, this seems overblown, I guess, some of it. But, and there are definitely some urban areas where the chance of wildfire risk may be comparably lower. I'd say that. But I think it's important for everybody in California to understand that much of our built environment stretches into wooded hillsides or grasslands, and that can bring wildfire over long distances into a suburban area. From the tunnel fire that burned so much of Oakland, we experienced massive losses in an area that was urban, but it extended into hillsides and a wooded interface. In the Coffee Park neighborhood of Santa Rosa, we saw a very flat, very suburban neighborhood that was moderately wildland adjacent, but burned in the Tubbs fire. So similar fires have impacted Ventura, San Diego, San Bernardino, etc. You add to that the heat and dry conditions from climate change, and it's understandable that we need to change some of our practices with regard to landscapes and our building codes statewide. So if you believe you have a very low exposure, at least tackle the tasks that you can reasonably do yourself or reasonably afford to have done for you. And remember, you get a discount for each of the safer from wildfire mitigation actions that were shown earlier. And ask your local fire department or maybe a local FireWise community member, what are the actions that have the most benefit to a given home? And remember, again, every action that an individual homeowner takes benefits their neighbors, all the homes around them, and their community. So it's really a generous act to do whatever mitigation you can at your home.
Thank you. The next question is for Sarah.
Okay, I'm here. It doesn't seem to, it says you cannot start your video because the host has stopped it. I got cut off. I got the hook.
Okay, somebody will fix that. Okay, but your question is, do the insurers actually recognize and value home and community mitigation efforts? Are they really taking that into effect?
Right, thanks. And I think to an extent, Joel talked about this with his slide, and we hit upon it with the, oh, here's my video coming on, and we hit upon it with the safer from wildfire regulations, because insurers are required to do so by regulation. I think prior to the regulation, there was a certain amount of that going on. There was people recognizing Firewise communities. Certainly, fire rated roof had been something that was getting discounts for a long time. But with the new safer from wildfire regulations, they are required to give discounts and recognize those specified mitigations and Joel showed the list of them. So absolutely, they recognize it and they put both a value on it, and then there's also part of that regulation talks about your risk score, and they give you information about your risk score and how you can improve your risk score and things like that, and the ability to appeal your risk score. So that's a requirement.
Okay, Philip, the next question is for you. What should homeowners do when they can't find insurance and their home's value is well over the $3 million mark and it can't be insured by the FAIR Plan?
Well, if they're getting to a situation where their TIV limit or the total insurance value of their home would exceed what's available within the FAIR Plan policy, it would be important to look at the surplus lines options, because again, I still see those options available. The process takes longer, and in some cases, you're going to be paying a lot more than maybe you had previously. But again, from what I'm seeing in the marketplace, those options and surplus lines are still out there. The process is a little bit different, takes longer, and you really want to make sure you're working with a broker that has experience in that space as well.
Okay, let's go back to Sarah. Thank you. Sarah, do outside intervener groups add costs and delay the rate filing process?
Oh yeah, this has been a hot topic lately. And certainly, yes. I mean, and there's primarily one intervener in the state of California who collects most of the money from intervening on these rate filings. We know they can extend the time frame for rate filing from months to years. In fact, I just saw in the CDI's system, there's a filing in right now for a company. There's going to be a $3.50 surcharge on every policy to recoup. There's over $5.5 million of intervener fees. And the irony of it is actually the interveners in the administrative litigation, the judge denied every one of their points. So they actually intervened, contributed nothing to the rate filing. The judge denied them everything. And yet at the end of the day, the insurer was compelled to pay out $5.6 million. And now there is going to be a $3.50 surcharge on every policy to cover that cost of extending the rate filing process and disrupting the market. Great question.
Joel, do you have any useful recommendations for companies that will insure us for a reasonable amount?
Mary Beth, could you repeat that, please?
Do you have any useful recommendations for companies that will insure us for a reasonable amount?
Well, I think one of the things that comes about in people's hunt is they only have heard of a very few insurers, and California market has been, dominated by a well-known set that do 90% of the advertising you see about insurance on television. And people should understand there are a lot of excellent insurers that write lower premium volumes, but provide, same coverage or sometimes better coverage at the prices, again, approved by the Department of Insurance for the admitted carriers. So again, that's why that the top 10 tips and that list of 800 numbers of all the carriers. There was a news release recently that Tokyo Marine had stopped writing homeowners insurance in California. Most people didn't even know Tokyo Marine wrote homeowners insurance in California. Just as an example, and as I understand it, they have started writing again, but there are a whole set of carriers that we just don't really hear much about. But American Modern, it's just a long list of insurers. you need to try them all. You know, it still can be pretty challenging to find one that will write you even with that many choices if you have a pretty high wildfire risk. But you know, you really want to at least have put up the fight to do all you can to stay out of landing in the FAIR plan.
And Joel, what about the issues that people are having with older homes that are 50, 60, 100 years old? Somebody actually wrote to us, and I referred him to the newsletter that you had put out about older homes. What can you tell us about that?
Yeah, you know, I think for most insurers, they don't go by necessarily the strict historical age of the home, but they go by the age of the conditions that lead to the most losses in a home. So what they're looking for are updated plumbing and heating systems and roofing, electrical systems. So it's pretty common for an underwriter to consider a home to be pretty much at the age of its systems. You know, the wood cladding of the home really doesn't matter what the age is. It's really about those things that can result in a leak or spark a fire or have lead to further damage that insurers care about. So if you have a Victorian home, you know, you really need to make sure you've updated those systems.
Okay, and Philip, maybe one last question. What are the increased costs for insurance use in the California FAIR Plan? I know I go out and speak myself to my areas that I have that I cover, and I'm also often asked, well, can I just get the FAIR Plan and not get the wraparound? Can I get a wraparound and not get the FAIR Plan and just take that on as my own risk? What's the best way for people to navigate the FAIR Plan and the ins and outs of it?
Well, I think that what's been interesting to see, for one, is the consumers have become much more knowledgeable through this process. So it's important to be informed through all these organizations that are helping them become informed. And that's why we're here today. And really just understanding the components of your insurance, because the FAIR Plan itself, the elements are all customizable. So you really want to, and obviously they're going to be more expensive than your typical choices, due to the nature of where the homes are located and the circumstances. So you really want to be selective on the elements that you're choosing, make sure it's important. They're ones that are important to you, and they are your home's insured to value first. So let's start with the dwelling itself and make sure the home is insured to value, and really just kind of work on each element that's important to you and customize it down the line, and then start looking at your options. And again, we encourage everyone to look at brokers beyond the folks you've normally been working with, just to hear some different schools of thought. You know, I use the term, you know, insurer of the last resort for the consumer, not necessarily the broker, because sometimes brokers might not have the availability that a different broker might have, or they can get access somewhere else, even for an HO3 policy. So again, I think it's important to, like the message that's been put out, start early in the process when you shop, be informed, look at resources that are available, and just really be selective in the elements that you're searching. And again, with the goal that when you're buying a FAIR Plan policy, if something else becomes available in the middle of your term, there's no penalty to switch out of it and get into that policy that's now available, because that's the day we all want to see come back. And you know, that's really what it's intended for. So hopefully that answers your question.
And I know that the FAIR Plan actually grouped their discounts all together, right? So for the structure, for the surroundings, and for being fire-wise. And when I go out and speak, I always really congratulate the FAIR Plan for actually, you know, working with us with Safer from Wildfires, because we don't oversee you like we do the other insurance companies. So I do shout out about that. Will that be changing? Will it always be discounts based on the different groups?
Well, in the way it's set up, and I think it's nice for consumers, because depending on the age of your home, as an example, like defensible space is in line with what CAL FIRE's expectations are anyway for homes. So it's really nice that if you're following CAL FIRE's guidelines, you know, you're more than likely going to qualify for that defensible space discount. And then the home hardening discount, because of all the elements, there are a few that, you know, unless it's a newer home, like enclosed eaves is one where that's something that's probably only going to be on newer construction or someone that just got a new roof put on. That may be one a little bit more challenging to get. And then the FireWise community is a community-wise discount, which again is a great organization, great resources, and really a great mindset, you know, for folks that live in areas that are more fire prone. So again, I think those seem to be well received, and they're very, I think, beneficial discounts. Sometimes there's discounts that exist that don't really make much of a difference to your safety. It's just a discount. In this case, these are very beneficial, meaningful discounts.
Okay, well, thank you. Do you want to have any closing remarks? You want to just state your website or anything like that before we wrap this up? Come on, Joel.
Jump in. Yeah, you know, it's a really frustrating time for a lot of homeowners. I think, you know, you can, again, we advise people, you can only do the best you can. So, you know, we know this kind of puts a lot of tension in people's lives, and never really had to consider insurance so much. But, you know, put some effort in shopping around, put some effort into mitigating your home, do what is within your control. And, you know, there is a lot about this market that isn't in any individual's control at this point. So, you know, we do hope that some of the future changes that occur do open up the market a little bit. But, you know, just do what you can now. And if, you know, you end up with a fair plan, that's not on you. That's just the way the market is working today. But keep trying to find another carrier, even if you do end up with a fair plan. And still try to keep your coverage limits at a reasonable level, because, you know, you need them to respond. That's why you're buying insurance coverage. So don't compromise your coverage so much that, you know, you can regret it. I've done a lot of post-wildfire events, helping consumers work through their policy, and being underinsured is really a bad start on the whole process. But, you know, I wish my best to everybody, and hopefully this time next year, nobody will be interested in listening to a bunch of people talk about insurance in the middle of the day. So thanks.
Darren?
Sure, thank you. You know, just really to thank everybody for this. I mean, I agree, it is a difficult time. We are, you know, really living through this moment of climate change and adjusting in real time. And, you know, it's painful for everyone, and insurers are experiencing it themselves, and obviously the homeowners and consumers as well. I believe we will get through this, and so we just really have to all work together, and we're going to, you know, we will eventually resolve this. But right now, it is just living through, to be the generation that's sort of living through this moment of climate change and feeling the housing market and insurance price climate change into the housing market, and all these things is really evolution in high speed right now. So it's difficult. But thank you to everyone for being here and your time and attention on this important issue.
And Philip?
You know, I think echo everything that has been said. You know, we're here to collaborate. We're here to be a resource too during these tough times. I think more than anything, you know, I'm here as a resource to help educate or just inform anyone that has questions about the FAIR Plan directly. We can provide my information directly. Feel free to reach out. Just want to help you, because again, I hear the term that Saren used, the unfair plan, or whatever words that are used out there, and you know, I understand it, because you know, people are, it's expensive, you know, and really it's just more the shock of the circumstances. It's not about the FAIR Plan in general. You know, and I personally am involved a lot in El Dorado County, the part that borders Nevada, and you know, the state line side, it's the same part of South Lake Tahoe. There's no FAIR Plan in Nevada. And so the same exact neighborhood on the Nevada side, there's no FAIR Plan option. It's very different and much more expensive. So again, I am fortunate for the FAIR Plan. I'm grateful to be part of it, and I believe in everything that we're doing here to fill the need. But again, our goal ultimately is to see the market restored and a day that where we're no longer needed.
Well, thank you, gentlemen.
Thank you.
So, and thank you for joining us. If you need any specific information about your policy, you really need to call the helpline, the 800-927-4357 line. There you will be, the phone is answered by the compliance officers. They are the only people that are allowed to go into your specific home policy and get into the details. So if you want some good help, that's the best option for you, because I myself or the other people who work for the department, they cannot do that for you. You have to call the helpline. You can do it through the phone or on our website. And thank you once again. And we were going to do our best to answer all of the questions that were submitted. They were a multitude of them. So give us some time. Thank you so much.